All right, there we go, everyone. Thanks for joining me. Today is Monday, June 29th, 2020. I cannot believe that half the year is going to be done tomorrow. I sound like my dad, but time just seems to be flying by. Exciting times as we enter the summer. Markets having rallied here 6 of the last 7 weeks. I do have a very special guest today. I'm excited to bring him in, but first, as a reminder, I'm Rob Tetrault from robtetrault.com, portfolio manager here at Canaccord Genuity Wealth Management and at the Tetrault Wealth Advisory Group. I'm going to ask you, if you're watching this on Facebook, please give us a share, a like, or a follow. Love to hear your comments. If you're watching us on YouTube, take a second and subscribe to our channel. We got some great content we put out all the time, and we'd love to have you as a subscriber. If you're watching this, please don't hesitate to ask questions as you may have them today. Really excited with our guest. I'm going to bring him in right away here. None other than, I call him KV, but Kevin Vandermeer. He's a CFA. He's a fellow of the Canadian Securities Institute. He's also Managing Director, Investments and Advisory Solutions at Canaccord Genuity Wealth Management. Kevin, thank you so much for joining us and welcome.
Thank you for having me, Rob. And it's great to be. This is my second time, so I must have done okay the first go around. So thanks for having me back.
You did great the first time, and I'm confident you're going to do great this time also as well. There are some headlines today. I'm just looking here at the screen for the end of the day. It looks like the Dow finished up about 500 points at the end of the day. The TSX finished up 200 points, closed at 15,389. The TSX 60, 928. It was a big day today, a 2% gain pretty much across the board. Gold was up, oil was up, WCS, which is our Western Canadian Select, was up. What are your thoughts on just a big Monday like that? Usually we don't see this type of movement on a Monday.
Yeah, very unusual, but I think you got to sort of take into context. Obviously, Friday was especially weak, and last week was weaker. As we're going to talk about, there is still a lot of cash on the sidelines, and I think there's more people that are trying to find a way to come in and get involved in the markets. So a really weak week last week. And
a week
last week, and this not entirely surprising to see a bit of a bounce today, I think.
This is a chart here showing it's a CNBC chart. About half of the U.S. population is jobless. I don't know if you can see the percentages here, but the top is about 65%. This is the total population that has jobs. 64.7% was the peak in April 2000. That is 20 years ago, Kevin. And we dip now at about 52%. This is an American stat, obviously. Dip to about 52% of the population that has a job right now. So that's, would you say, troubling?
It is really unprecedented, as we all know. Anybody who's been a student of economics or a student of the markets, this is nothing like we've ever seen before. But I think you need to put this in context. This is not a traditional recession in the likes of which most people would have experienced in the past. This is really a pause, a regulatory pause that's been sort of forced upon us all for reasons that we all know and understand. And what's interesting and kind of, there's some really interesting stories coming out of the U.S. I just read one moments ago that as the government is putting money into the economy to support people that can't go to work, people who are getting $2,000 in New York, it's very different. What you can buy in New York for $2,000 is very different than what you can buy in Florida or New Orleans or elsewhere in the U.S. And so people are going out and they're spending money on TVs and call them toys. So I just read just before coming on here that some of these dealers
discretionary spending
is just off the charts.
Yeah, well, we know, I talked about on the show, You can't get a hot tub in Winnipeg, Manitoba. You can't get someone to redo your landscaping. You can't get someone to do your deck. You can't rent an RV for a weekend or buy an RV. All of those are what I'm calling the COVID trades. Just people wanting to spend on this discretionary basis, and the lack of travel is putting all of those into question as well.
I have a personal story really quick.
Share it.
Obviously I've been, I'm based in Toronto right now. We don't, we're supposed to be self-isolating. So I've been riding my wife's bike from university, her mountain bike, for the last 2 months. I've tried to go buy a new bike for myself because now I've committed to, said like, I'm going to make a commitment here. So I went to Canadian Tire, went online, bought the bike on Canadian Tire online, waiting for them to pick me up, tell me to come and pick it up. They sold the bike. So there's really no bikes in Toronto for less than $1,500. So you've worked your way up. So this weekend, much to my chagrin, I spent $2,500 on a bike.
Come on. Holy
So I better ride this thing. So that's sort of my commitment. But just to get, again, that's like my testimony. That happened to me. I've been looking for a bike. I was looking to spend about $600 to $700. All of those bikes are sold in Toronto, basically.
What does a $2,500 bike do that a $700 bike doesn't do? Does it drive itself?
You'll have to have me back on the show, and I'll tell you.
I guess. You are looking good. You look like you lost some weight, so that's good. The biking is helping out. A couple other headlines today. Some companies filing for bankruptcy protection in Canada. This one hurt me when I saw it. Cirque du Soleil. Did you see that story? Cirque du Soleil, as you guys might say.
So they're unfortunate. I mean,
they're laying off 3,500 people.
Yeah, I mean, I think they were looking for some people to really support them, and I know the Quebec government was going to try to, kind of help them out a little bit. But I think
they were looking at
it's done. I don't think it's done. It's sort of they're protecting themselves, and I think we'll, hopefully we'll all get to see those amazing shows, whether they're in, Vegas or in Montreal or Toronto or some of the other cities. I mean, just amazing work by that company of actors and performers. But just unfortunate.
What's your favorite Cirque show? Mine is, while you think, mine is Beatles Love. It was so good.
Yeah, I'm trying to think of the one I saw. I think it was it had a water feature in.
I believe it's called O.
Oh, that's right. Yeah,
it's like an O.
Yeah,
and that's a French play on water. But and then in the U.S., Chesapeake Energy. This was a $400 stock 6 months ago, and now they're pretty much belly up. The stock's at $10 today, down like 98% or whatever it may be. We thought we wouldn't see that one go belly up, but here we are. That was a I think they were fracking, or they were in the shale, if I'm not mistaken.
Yeah. I mean, I think that without going into too much detail, I think you're going to see more out of the U.S. shale, and that's because for a long time, Saudis have asked not to get into too much detail, but the U.S. shale guys have been really overproducing, and as a result of that, Saudis have been losing market share. And that's why the Saudis a couple months ago responded so hard in cutting price. And they knew that once they cut price, shale production would no longer be profitable. And as a result of that, we're going to start to see, some cutbacks, which is exactly what's, Saudi and OPEC wanted, because they want to get their market share back. And what you're seeing is the result of that. So it's unfortunate, but I think, Rob, we're going to see more news like that out of the U.S. shale.
It's what they want to see. Obviously, that's why they're doing this, right?
Yeah.
580 points we closed today, so that's definitely a good Monday for sure. Another story I want to touch on here. This one was an interesting one. Facebook has been in the news because a lot of companies are pulling their ads. Pepsi, Starbucks, a couple other companies have pulled their ads from Facebook as a result of this civil unrest and the position that Facebook has taken on what's happening in the US. Surprisingly, the stock was up today. It fell early this morning in trading, and then it rallied throughout the end of the day. I mean, it's been down a lot last couple of weeks. Any comments on that?
Yeah, I think that, look, we're all very sensitive to the the social issues that are arising out of some of the things that have happened in the U.S., whether it's protests, etc. And I think I think the general corporate environment in the U.S. is trying to figure out what its role is, and they don't necessarily want to be complicit in something like Facebook, which I think many people have been critical of their inability to kind of stay consistent with what they've declared on their website they're going to do. They've kind of bent the rules a little bit. And so, you've seen big names like Pepsi, you've seen Verizon step back, Coke has stepped back. So these large corporate entities are stepping back and saying, we're not going to advertise on Facebook for 30 days until we can properly assess, that this is not a platform that's going to be being used for negative reasons. And so they're just being very, very careful with their brand. And I think, Facebook is incredibly important to so many small businesses, so it's not going away. But it's more of a message to Facebook management and ultimately its shareholders to kind of encourage Facebook to be a little bit more, authentic to what they've actually stated is their own personal rules or their own code of conduct.
Speaking of Facebook, their revenue from the two presidential candidates in the last week. So President Trump ramped up his spending in the last week, $2.2 million spent on Facebook ads. That's about 50% more than Vice President Biden, former Vice President Biden. But more importantly, what surprised me, so they're going to obviously spend a ton of money on Facebook ads here all the way to the election. I don't think that would surprise anyone. What surprised me was that the June number for Biden came in almost double what Trump spent on Facebook ads. So I was surprised to see that. But we do know that Trump is going to open up the wallet here and spend on Facebook. I think that wouldn't surprise anyone.
Yeah. It's a great way to play the election as Canadians is, buy some Facebook and pay the spend for sure. And Biden obviously leading, so Trump's going to need to spend some more. So, yeah.
Last story I want to talk about here. It's a Canadian story. Tim Horton's app under investigation for data tracking. So this is potentially tracking consumers prior and after purchases and stuff like that. I don't think anything's been proven here, and I'm not alleging it has been. It's just a story on BNN and Bloomberg. But still, the stock is up 5% today, QSR. That stock is not quite as high as it was kind of about a year ago, where it was like $100 or so, $105, but it's still at right around $75.
Yeah, I actually didn't see that story, but Tim Hortons actually came out, or they're called, what is it? International Brands is the
Restaurant Brands International.
Restaurant Brands
QSR.
International. The QSR is the ticker, and they actually came out this morning with a report highlighting they own Popeyes, and they own
Burger King, I think.
Burger King, and then obviously Tim Hortons. And they gave a corporate update this morning that came out before the market opened. And I think the general tone there was that they're seeing better traffic and they've opened up more stores faster. So that's what I think you're seeing today in the market is that kind of corporate update was more positive than I think most of us have, what the market was anticipating.
There's your 5% bump on the stock. It was a $40 stock in the middle of March, and it's now at $75.62. Hey, last article I said last one. This is really the last one. There was an article that you highlighted about the impact of Biden as president to the Canadian stock market. And it's a report that was issued, I believe, by CIBC. They looked at most of the sectors, but financials, materials, tech, and utilities, they said could actually have a positive impact by President Biden, even though most of the market's expecting a negative impact on the stock market, mostly because of corporate tax rate. They outlined 4 sectors that could potentially positively benefit: financials, materials, tech, and utilities. So there you go.
I think.
Go ahead.
Yeah, I was just going to say I did see that article, and I think it's everyone right now. I think it's unusual for a sitting president to be unseated, The only time a sitting president is unseated is usually during a recession. And we are obviously clearly in a recession, but this recession is a little bit different. And I think right now, what's unusual is that Biden is leading by 14 points. Will that close over time? Probably. But that's not necessarily what the market thought would happen. And as a result, you're seeing strategists come out and we're starting to think about what the world might look like under a Biden administration. And I think that the key takeaway there in that, what they were trying to hint at was taxes are probably going up. And like, if you don't think your taxes are going up, the taxes are going up everywhere. Under a Biden regime, taxes are going to go up faster than under Trump, and you're going to probably see more regulation. I think that was kind of the essence of the article. In highly regulated sectors of the economy will probably benefit more than others. So I think that was the essence of it. Not
Cannabis.
To go on too much about that.
No, and cannabis is one that they highlighted specifically.
Yeah, which actually that was the one I found interesting. But look, every state and municipality in the U.S. is going to need more tax dollars. And so cannabis is being treated much like tobacco and alcohol, is a source of revenue. So I don't think the states are certainly not going to pine on whether it's, there's no moral issue here or judgment. What they're really looking at is an opportunity to garner additional revenues and taxation as they've spent and are, challenged financially.
Yeah, I was a big cannabis bear at the top. I went out and I made videos and I went on BNN and I said, this is potentially a bubble, guys. Be careful, be careful, be careful. And now I'm starting to look at these prices and goodness, they've fallen a lot. There's going to be a point here at some point where they're going to be extremely attractive. Yeah,
I agree. And I think you're going to see consolidation. So just, these guys have got there's too many of them. They're going to have to consolidate. And, there will be, I think, some good opportunities to kind of pick through the rubble here and take advantage of some things.
All right. So again, I'm Rob Tetrault from robtetrault.com, portfolio manager here at Canaccord Genuity Wealth Management and at the Tetrault Wealth Advisory Group. I'm here live with Kevin Vandermeer, KV, as I like to call him. I just made up that nickname, but I'm sticking with it. We're going to talk today about some points to consider. We're looking at some of the stuff that you've sent out to advisors in the past, specifically guys like me. So you work, you're at Canaccord Genuity, managing director. I just want to get this title right here. Managing Director, Investments and Advisory Solutions. So you work obviously on research. You're a CFA, so you're a Chartered Financial Analyst, the highest designation you can get in our industry. And you also work directly with guys like me to help with our practice, research, finding valuable information. You guys that have been watching the show, you've met Javed a few times, Javed Mirza, Martin Roberge. We're actually bringing on the show Scott Chan next week and some other analysts as well. So these are like my teammates at Canaccord. For those of you that are watching, we work together to build on portfolio strategy. And we thought it'd be really neat to take you through some of the points to consider, some of the stuff you've sent out in the past while. If you're watching on Facebook, please take a second to like, follow, and let us know your comments. And if you're watching on YouTube, please take a sec to subscribe. So this is my first chart here that we're going to show your first chart. Hopefully that's legible. I'll let you chat about it.
Yeah, sure. So, I think we all know that the market really, kind of declined quickly and fastly into a March low, as a result of the pandemic, as a result of the shutdown globally. And then what's happened is we've come as fast as we came down, we've come back out of that decline, and much faster than really any of us have really ever seen or would have anticipated. So really what this chart shows is we've laid out, I think there's something like 8 or 9 bear markets here. Going back
1982, 1984, 1996, 87, 98, 2002, 2009, 2020.
Yeah. And so every time it feels different, it feels unusual, it feels painful. And what we did was we went back in our research and said, okay, what does this look like relative to, say, 09, in back in history. And it turns out this is like the second biggest jump off the bottom ever, or going back to at least 83. So you can see some of the others, but certainly, the bounce has been really, really strong. I mean, really,
It's
that's
almost,
what we're trying to highlight.
this is a great way to see it kind of in one chart. And if you had the opposite chart, which I think you did have, and if we've showed it, you and I, before, but the drop was also the most precipitous drop that we've seen kind of ever, right?
That's right. You'd have to go back to 87 to see the kind of speed that we saw. And then, to kind of put it in context, normally, if you think back to kind of, most of us would have been around for the kind of 2008 scenario. But, normally at the top of a market, the market tops are made gradually, and a market will kind of decline over a period of time. And usually that time could be kind of 150 days. So think of about a 6-month period of time where the market's laboring, and then eventually it capitulates. And you can go back and look at 07, the market kind of peaked in the summer, but it wasn't really until the fall of 07 that it really collapsed. But this time we saw what normally the market would do in 150 days, really did it in like 22 days to kind of frame it. And then, not surprising, we've come off the bottom really, really hard and quickly. So that's really kind of what we're trying to show here.
Yeah, the 65 trading days, those of you that can't read the chart there, it's 38.6%, and the S&P 500 is 41%, the strongest move off a bear since 1971. But 87, if we're comparing 87, as I've heard the stories, the war stories from all of my older colleagues, that really was a one-day, like, dish ragging, as they would call it, right? A one-day dish ragging, which was, I think it was like 22% in a day or something, 23% in a day, and then kind of a few other percentage points.
Yeah, and actually, as a result of that, for those who are real students of the market, what happened was, as a result of that move in one day, the markets around the world now have what are called curves. So, and we saw that actually during this pullback, where the market will pause. So once it goes through a couple of circuit breakers, then you get almost like a timeout, and so the market will pause for 30 minutes and then reopen again. So some of the pain of years gone by and the pain of others has now been implemented in market structure now, and sort of slowing down the speed at which markets can fall. So we really will probably never have hopefully another 22% or 28% drop in one day, but we certainly had some 10s and 12s through this last period.
Yeah, like at 30,000 points on the Dow, that'd be like 7,000, almost 7,000 points in one day. So we felt 2,000 points that one day. Was that Friday the 18th, I think it was 2,000 points. Yeah. And that was a lot. Imagine 7,000 points. So if you're bored and you're watching the show and you want to learn more about circuit breakers, we did cover it as a topic in one of my shows. I believe it was either my first show or my second show, because that day that I was on here live, we tripped up 2 circuit breakers on the S&P 500. So go back into time and check the video, I believe from March 23rd, or it might be the week right around March 23rd. I know we covered it in our chat. So if you're bored and you want to learn about circuit breakers, go back and check that out. I think one more comment you can make about this that I would make, and you'd probably agree, is that I think due to just the speed of the networks and the cell phones and the accessibility of information and everything that we have now, I don't think we would expect market cycles to be slower than they have been. Would you say?
Yeah.
Like, given that everyone's got a cell phone at their fingertips now.
And not to date myself too much, but when I entered the industry, we used to get all of I worked for a portfolio manager, and I would literally sit by the fax machine, and that data would come off of a fax, and I would read him the headlines and the earnings, and we would be saying like, oh, the company came in line with expectations, or there was ahead of expectations. And you'll remember back then, you had these things called whisper numbers. So there was, everybody had kind of different information. There wasn't the complete disclosure of information that we have today. So some analysts had better information about the company than others. All of that has been changed, and is, now all analysts get the same guidance, the same structure. But yeah, so now the speed at which information moves, think about how well we are all informed about what's going on around this pandemic. We are, if a company warns, or there's a fire in a city, or there's a challenge with a business, within minutes or hours, we are all well informed. And you can imagine the speed at which that information now is getting built into markets. Everything's moving, kind of 3 or 4 times faster than it was, 10, 15 years ago. It's pretty amazing.
It would just take longer for the cycle to go through, because you're a plumber, or you're a business owner, and you go out there and you see on the 6 o'clock news that the market fell. Well, it takes you a while to then call your advisor, and maybe you're selling the next day, maybe you're not. And it would take days over days over days over days for that compounding negative sentiment to take place, whereby now you're all seeing it on your phone. It's negative. It's negative right now. So let's sell now, right?
Yeah.
You get that acceleration factor. I'm going to take you through the next slide here. It's titled "Sitting in Cash."
Yeah, so a lot of people have a sense that, look, because the market dropped so quickly and then bounced back so fast, and because many of us, weren't around for the Spanish flu, which was the last pandemic in the 1912 or so, most of us that are professionals have never been through a pandemic. We've been through lots of recessions. So there's still a lot of uncertainty in terms of the economy, even though we can see that the economy is improving. But there's still a lot of cash on the sidelines. So, if you're listening to this show and you're saying, I've missed this bounce and I'm still sitting in a lot of cash, well, know one thing for sure, and we'll get to some of the things that we think you should be doing with the cash later in the show. But just recognize that there's a lot of people that are also sitting in cash. And as somebody who's a student of the markets, we would see this as a positive. Why is this a positive that lots of people are sitting in cash? It means that you still have people that need to enter the market, that still need to invest. And obviously, we actually have more cash than we were in 2008. So professional money managers need to start to work this capital back into the market. And that can be one catalyst for why this market can continue to go up, even though, as we just showed you, is up a lot.
Yeah, I think for those of you out there that need to be reminded, the issue of cash is adding buyers, adding liquidity to the market. So the more buyers you're adding to the market, if you have more buyers than sellers, your market's moving up, right?
Yeah.
Yeah, this is a neat chart. I'll take you through here to the next one here. This is the net short position. Maybe before you could just take a quick sec and clarify.
Yeah, so this is exactly a little bit, this is a little bit more of a more complicated chart, but if you look, so there's obviously lots of different people that enter the market. There's retail advisors, people like myself, people like Rob and others that manage money for people, and then there's obviously big institutions, and then there's hedge funds that are trying to make money going long the market, so buying the market, but also shorting the market. And when somebody shorts the market, they're hoping that the market goes down. So what you're looking at here is a chart where, and it says the bears are back. So bears are people, investors that want this market to go down, or a market to go down. So whenever you see the red line here, it means that people are betting or have placed bets for the market to go down. And where you've seen green is where you would expect people are expecting or have put bets down for the market to go up. So right now you can see that it's quite negative. And again, as investors of other people's money and stewards of other people's money, while this might seem very, very negative, we actually see this as a positive, because it means that these short sellers, or people that are betting that the market needs to go down, are going to have to eventually cover their positions. And again, that's more buying power, more people that need to enter the market and either close off their positions or buy in the open market. And so, again, historically, when we've seen these extreme moves or extreme negativeness, or the extreme bears, if you will, or people that are betting that the market goes down at these kinds of levels, typically the market will move higher over time. And so this is sort of a, if you will, a harbinger of positive movement over the next 6 or 12 months. And we'll show you a little bit more of that later in the show.
There's, for those of you that don't understand shorts, real briefly, I'll try to just clarify it. But basically, if you think a stock is going to drop or the market is going to drop, what you do is you borrow it from an institution, a financial institution, such as Canaccord Genuity or a bank or whatever it may be. You then go out and you sell it, and you are therefore short the market. So you have sold the security, and in our terminology, we would call that being short. You are then hoping that at a future time, you can buy the security back, and you would therefore cover your short, or you would therefore be a neutral position. So you sold 100 shares of SPY, and now you are buying them at a future date. And when you're buying them, you're hoping that the price is going to be lower than what you sold them at. Therefore, you would have sold higher and bought lower. It's the reverse of going long. Now, there are costs associated with this, specifically interest costs, because you're borrowing money to do this. Also, you're borrowing stocks to do this. So you also often have to pay a premium to borrow a security to do this. And remember, your loss is boundless. Your potential loss is boundless, because what happens if that stock starts going up, at some point you have to cover your short. And if you're on the wrong side of that trade, it's not pretty, ladies and gentlemen, because then you're buying at a much, much higher rate. And we've all seen the world famous short squeeze, where the short people are trying to cover a short and you just get squeezed out. So squeezed out meaning the price goes higher and there's nothing left for you to sell. So that's hopefully in a nutshell made a little bit of sense to you. Kevin's point here is that the shorts are back, and that means people will have to buy securities to cover their shorts. Very, very good chart, Kevin. As a reminder, I'm here with Kevin Vandermeer. I'm Rob Tetrault from robtetrault.com, portfolio manager, Canaccord Genuity. Kevin is our managing director of investments. He's a CFA. And if you're watching on YouTube, please subscribe. If you're watching on Facebook, please do the same. I believe it's like and follow and give us your comments. I'm going to take you to the next slide here, Kevin. This is the bull market analogs for the American market.
Yeah, so this is a really interesting chart. So we've talked about the market pulling back. We've talked about the market bouncing and really having this really, really strong move off the bottom. So what you should be asking yourself is, okay, what next? Where is this market going? And so this is some work that was done by Fidelity, just some really great work on the U.S. market. And basically it said, after we've had this big bounce, and it's called the first breath peak. So you can see how they've lined up every line and kind of put a pin in all of the markets that have gone up a lot. And then there's kind of this kind of where it takes a breath or a breather, and any of these rallies have kind of paused and pulled back a little bit. Very natural. But as we can see, most of these lines, and again, the work that they've done goes back to the 30s. So again, we're looking at markets where you've had this severe pullback. So you'd expect kind of a recession or a market correction kind of every 5 years. So I think there's 20 scenarios there. But you can see over time, and this is kind of how markets kind of repeat or rhyme. Each one of these recessions happen for a different reason. But you can see over time, markets tend to recover. And so really what we're trying to identify here is that if you are sitting on cash, if you just went through this big roller coaster and you're like, get me off, or, you feel like you've missed the whole move off the bottom. What we're trying to highlight here is that we think 6 months or 9 months from now, or even a year from now, on whole, markets will be higher. And we have a lot of confidence in that because we're looking at 20 scenarios in which that happened before.
I like that. I like using a lot of data. And if you've been watching my show for a while, you've heard me talk about this. I talked about it on March 23rd. I talked about it right at the bottom there. I was saying when these things happen, they always bounce back. Now, this is a neat analogy. This is a little different than just, hey, markets fall and markets come back, because you've added the research piece about the first breath, where there's kind of like that one peak. And, we did touch on that a couple of weeks ago. So I do like this. I do think it's very valuable data, and we've seen 20 times. And of those, I think there's one negative market, and it was 1929, I would imagine.
That's right. Yeah, I think there's maybe two, or there's a couple that are just a push, but it's sort of like whether you want to say 17 or 16 times out of 20. Those are really good odds. And what we would say on top of that is that the Federal Reserve in the U.S. has put more money into this pandemic, more money into the economy than ever has before. So if we were just looking at each one of those scenarios, you have, let's call it 16 out of 20% chance the market will be higher. And then what we do is we adjust that probability probably a little bit higher, because the amount of stimulus that's been put to work in this market to support it is greater than any other time in history, which I think only further benefits our upside case scenario. Then, as we've talked about, layer on the fact that people will still have cash, layer on the fact that we have very sophisticated hedge funds that are short this market. Again, all of that would suggest there's kind of this positive support under this market. And so you go back to last week, a weak market. Today we're kind of recovering much of what we lost on Friday.
Hey, I'm going to put you on the spot. Hopefully you don't mind. If you obviously follow Javed quite closely, Javed Mirza, he's been on my show a couple times here in the last while. He sent out a note yesterday, I think on Sunday, but 2 weeks ago, he was on our show. He was talking about a kind of short-term correction, 5 to 10-ish% perhaps, which, he was pretty much spot on exactly in the next couple of weeks. He had said yesterday, there's potential intermediate range of a downside, maybe 5% exposure in the near term here. What do you think about that? And I know you don't look at short term, because you and I think alike. It's long term, or at least medium term. But Javed looks more at short term. What are your thoughts on that comment by Javed?
Yeah, I mean, what you need to do is understand that Javed writes a lot of his research. The work that he does is very good, very technical, but also tends to be very short term. So keep in mind, he's publishing weekly. He publishes every week. He's on a conference call with advisors like yourself, Rob, as you know. And his his focus primarily is on institutional investors and giving them guidance on what to do with large pools of money. So he tends to think in kind of 1 to 2 to 3 weeks. So when he talks about a pullback in the market, in many ways we've already seen it, but the summer months are a little bit quieter. And the reason is you have people obviously away on vacation. We have the U.S. Holiday on Saturday, but the U.S. market will be off on Friday. We have Canada Day. So this week's going to be very quiet. So it's not unusual that in the summer the market will go sideways or even drift lower. And so I think that's part of what his comments are, is that, understand the fact that the market could go sideways or down a little bit. But as we think about being custodians and stewards and guiding people with their retirement, or helping people save for their children's education or for a home, we tend to think longer term and a little bit further out. And so rather than trying to kind of negotiate every corner like institutional investors are required to do, we want people to think a little bit longer term. And so that's really what we're trying to do. I see that you put up the chart here of Canada. So this is
and you know what? Just one more point on Javed. I don't want to let this one go. Is that what I was going to add? And I thought you might say is that largely we're on the same page, because he's bullish. Yes. He thinks like all-time highs this year for the S&P 500, and he thinks we're in a secular bull market here. And he might see a little blip in the next week or two, But if he were here right now, he'd say like, just buy anyways, because we're going to be up at the end of the year, right? We're going to be up next year as well. He would say he's extremely bullish.
Yeah.
So I think you and him think extremely alike. You and I just worry less about the short-term, week-to-week fluctuations.
That's right.
We care more about the long-term. So yes, I did pull this chart up here for you.
Yeah. This chart is exactly like the one, or this chart is the brother of the one before. So this is the S&P 500, the U.S. market, and here we're showing you Canada. So you might have said, "Hey, Kevin, thanks for that, kind of analysis on the U.S. market, but can you show me what Canada looks like?" And so here we're showing you Canada. The underlying message is essentially the same. We didn't have as a robust data set as we did in the U.S., so we're only going back to 83, but you can see that on the whole, markets are positive, and here we're looking out kind of 6 to 9 months out, and the general direction would be positive. So again, message is, even when you come off of a bottom, even though you might feel like you've missed it, and it's pulled back, history would show you that 6 to 9 months from now, we're probably going to be higher.
Yep, I would agree with you there. The next chart here that I'm going to pull up is actually the chart that shows the average numbers. I'll pull that one up for you.
Sure. So this is essentially the same analysis, but instead of pictures, we're showing you in numbers. So people say, "Okay, great, Kevin, thanks for that. The market's up, last 50 days or so, up 20%. What can we expect in the next month or so?" And actually, when we did this work, the market was really only up. It was kind of up 20 or so percent. But this is really kind of trying to quantify it a little bit more. So instead of pictures, you're sort of saying, "Hey, what can I expect?" And so we've laid out for you in hard numbers here, kind of 7 scenarios when the markets come in the last 50 days, really strong off the bottom, and then said, okay, what happens in the next, kind of 1 month, 3 months, 6 months, and 12 months out, and you can see that the market is markedly higher. So, if people ask me, what do I think the market's going to be up in the next year? I'm conservative, so I'll tell you 7%, but the data actually says the market will be up 13%. And we've tried to pick scenarios that are as close to what we've just experienced.
Even though there isn't really anyone, right? And there's never really been that 50-day.
Yeah. But people would say, well, the market's gone up a lot. I've missed it. I'm in cash. I don't want to go in the market. And what we would say is, well, if you're data-driven, if you're systematic, if you're being objective and taking emotion out of it, as hard as it might be, this is the hard data that would suggest the market can still go up.
The next question that you probably get asked, and I get asked all the time, and I like this slide. In fact, I saw an article today on BNN saying that, Porter was still not ready to start their flights up. When are we going to normalize? When is normalizing happening, Kevin?
Yeah, so I really like this chart. I found this chart and I sent it out to our advisors, and I thought one of the interesting things is, obviously we all know that air travel is highly discretionary. The fact that I'm talking to you on a video conference rather than sitting beside Rob in his office in Winnipeg, or the fact that I haven't traveled in 3 months, and none of us are going to Europe or anything for any kind of a family holiday or anything like that, is because we're not allowed, but 2, in the middle of this pandemic. And so people will say, well, when am I going to be able to travel again? And businesses across the country their salespeople aren't traveling; they're doing sales conferences and reaching out to people by Zoom and other forms of media. So this chart was really sort of highlighting the fact that it could take a year. So think about a year from now, for the world to kind of get back to normal, or whatever that new normal might be. And a lot of people will say, well, the world has forever changed. And I would say, actually, I'm not really sure the world is going to change that much. I was in New York for 9/11, and I remember feeling kind of the full force of that event and thinking, that the world really had changed. I took the Greyhound bus home from New York to Toronto. Didn't travel much for a long period of time. You remember all of the security checks that we needed to go through to go to, simple things like a sporting events. Do you remember? And we had here in Toronto, they changed out all the garbage bags so you could see clearly that there was nothing being hidden in any kind of bags. But fast forward 10, 12, 15 years, world was pretty much back to normal. You had kind of curbside check-in for airlines. There were more people traveling by air than there was pre 9/11. And so as much as we're sitting here thinking that the world's going to forever be different, I would argue that probably in a year from now, we'll be kind of much back to our normal self. The only thing that I can really think of that's kind of a carryover from 9/11 is security checks. It seems like that whole security's beefed up a lot more, but I don't get on a plane anymore like I did for 3 years after 9/11 and sort of look around me and look at everybody around me anymore. It doesn't even enter my mind that there could be an event on a plane. So with this chart, I really like kind of guiding people to how we might get back to normal and when.
So 1 year from now, 2.5 million travelers. That's what you're thinking?
I think so.
I like predictions.
And
I like
today,
predictions.
I mean, the idea was today that, and I'm sure everyone's seen it, but there was social distancing for a while on Air Canada and WestJet, and today they sort of dropped that. They're going to pack us all in there nice and tight, and it'll be kind of up to you whether you want to get on the plane and sit right beside your neighbor and take that risk. So, again, we're kind of tracking that line. I'm not sure I'm quite ready to get on a plane yet and sit really close to somebody, but the airlines are certainly ready for you to do that.
For me, KV, I've not traveled since either late Feb or early March, and it's been awesome. Like, it's been great. Just home and not having to worry and being able to do these calls by Zoom and stuff. And I'm also not in a hurry to travel. I know I'm going to travel at some point. It's going to happen, but it's been great. I've been loving the time at home and enjoying my wonderful province. And if you don't know Manitoba, just a great province in the summer. You should. Have you ever been out here in the summer, KV?
I haven't, but I should. Maybe I should drive out this year.
Wow, the drive through Sault Ste. Marie and Dryden and Thunder Bay and Kenora is a little long, 21 hours, I think, something like that. But at some point you'll hang out here enough. And at some point we'll fly and it'll be back to normal. I would agree with you. I wonder if guys like me and guys like you, guys who travel quite a bit for business, are going to be taking, 1 out of every 2 trips instead of. Like, you don't fly for that 1 day meeting anymore, right? Maybe you just do it from Zoom. I don't know. I'm certainly not an expert in that. I do have another slide here. This is probably my all-time favorite slide. I love this slide. I'll pull it up on full screen.
Yeah, this slide I sent out. It's somebody put this together, and I think it's just a really good way to kind of finish a presentation. But you can't really read what's been posted here, but the title of the slide is Reasons to Sell. And so you have all these events along the line of the market going up, and they're all really good reasons to sell. Whether it's the credit crisis, whether it's situations geopolitically around the world, Trump getting elected, all kinds of kind of really bad events. And you can see that the market continues to go higher. And even in the face of this pandemic, we see again that the market is is recovered most of the losses, and we could see the market go to an all-time high before the end of the year. Certainly, probably next year it will go to an all-time high. So, the title of this slide is a little bit tongue-in-cheek, but the idea is, you want to be in the market. You want to you want to spend time with somebody like Rob and his team, where they can assess your risks, understand the financial goals, understand what you're trying to accomplish with the money that you're saving, and make sure that you have the right kind of setup in terms of asset mix, so how much you have in equities and bonds, so that you can stay in the market, so that when the market does pull back like it did, you're able to kind of withstand that shock. And let me tell you, there's going to be other things that are going to come, whether it's instability between the U.S. and China. This starting to percolate here a little bit. Obviously, the U.S. is unhappy with the way China's dealing with Hong Kong. You still have North Korea percolating. We have a U.S. election that may surprise the market. There's instability in the Middle East. There's always going to be challenges. The key is that you want to stay invested to benefit, to overcome whether it be inflation, but over time, markets tend to go up, and you want to capture that to meet your financial goals. And so that's really the point of that chart, sort of like I said, sort of in a satirical way, if you will. Reasons.
Yeah, I love it. We used to use one that was it's called 60 years of bad news or something, or 80 years of bad news. And it was like compound growth of 12% on the S&P 500 or whatever it was, and it was like Gulf War and Cuban Missile Crisis, and it went all the way back to the world wars and recessions. And you want to be invested. There's one question here that I'll take if you have time. I'll just show you this one, and let me know if you can comment on it. The air slide travel is from Peter. Is a good indication to perhaps put some money into airline travel stocks for the long term. I can touch on it quickly if you want, or you go ahead, Kevin.
Yeah, I would say so. Look, we try to stay away from individual stock recommendations here, but we don't own any airlines in our portfolios, partly because we don't have a really strong view and good visibility on kind of what capacity could what it's going to look like. We've showed you a forecast, but I would say if you are excited or you want to take a shot on airlines, I would suggest that you buy an ETF or buy a basket, because there are going to be some airlines that probably don't make it, and you don't want to pick the one that doesn't make it. Yeah. So the correlation between Air Canada, Delta, United Airlines, Alaska Airlines, all the correlation is going to be very high. What I mean is it's going to move as an industry, and it'd be better to just own an ETF that captures most of those names and you can play it, where there might be some that don't make it and are bought for pennies on the dollar. And as a result, you just don't want to pick that one. And then I would argue, if somebody's making a strong case, to just be a bit skeptical of that, because to be honest, we just don't know what it's going to look like. I know from internally, our bosses are quite happy that we're not traveling, and the most profitable parts of some of these airline businesses is business travel, because we tend to be less less price sensitive, and how quickly that travel comes back. Yeah. Over to you, Rob.
I would just echo all that. I'd say again, Peter, or whoever, we're not here to give investment advice. Just know that if you are buying into airline stocks, now that's a risky proposition. Make sure it fits within your risk tolerance. Make sure it fits within your asset mix and your long-term plan. And I'd say make sure it's a portion of money that is speculative and that you could afford to lose, because we would hate for you to put everything in the airlines and then they actually don't come back. That would suck. So again, we're not here to give you investment advice. We need to talk about stories and talk about more general topics. And don't take this as investment advice, as a disclaimer. All right, so I will end it there, guys. Thank you so much. Kevin Vandermeer, thank you. I'm Rob Tetrault from robtetrault.com, portfolio manager here, Canaccord Genuity Wealth Management. If you'd like to schedule a no obligation consultation with me, please go to www.speaktorob.com. We'd be happy to have a chat. If you want to chat about this, your planning, your outlook, your portfolio, maybe you're not, maybe you don't think your asset allocation is right now, or maybe you just need a fresh eyes on your portfolio, by all means, reach out to us. We'd love to chat with you. Kevin Vandermeer, thank you so much for taking the time. Kevin Vandermeer, CFA, FCSI, Managing Director, Investments and Advisory Solutions, Canaccord Genuity Wealth Management. We will get you on again, buddy. I appreciate you spending the time today. And if you're watching this on YouTube, take a sec to like, subscribe, and on Facebook, give us a like and a follow. Thanks so much, guys.
Thanks. Have a great rest of the day.